let you know, diversification can only reduce some risk, but diversification cannot reduce all risks. It is because there are two kinds of risks. Total risks is the sum of firm-specific risk and market risk. Firm-specific risk is the portion of risk attributable to firm or industry factors that only affect a single firm or affect a single industry. But market risk is the portion of risk attributable to overall economic factors that will affect all the firms in the economy or in the market. So there are two different kinds of risk. Further elaborate. Firm-specific risk, also called unsystematic risk, also called diversifiable risk, while market risk, also called systematic risk or non-diversifiable risk. In Cantonese, 非系統性風險、可分散風險、系統性風險、不可分散風險。嗱，咩系統性風險啊？非系統性風險啊，大家會成日都聽到。系統性風險即係話你冇辦法透過分散去 eliminate 嘅，成個市場都係呢啲風險底下。嗱 give you some examples. So firm-specific risks only affect that single firm. For example, if that firm has a legal risk that due to poor quality of good, okay, say the good produced by the firm is not up to the standard and now having some legal litigation. So this is firm specific. Or the firm has very poor human resources policy and now the labor is going to strike, unwilling to work. So it only affects that single firm. So it is firm specific risk. So other example is like okay, the CEO just have a car accident, and without the CEO, no one is suitable to manage the firm. Firm-specific risk. Or the raw material for particular industry increase. Then that is still unsystematic risk. It only affects the firms in that industry. Then what about market risk or unsystematic risk? Market risk and systematic risk are risks that affect all the firms. For example, inflation risk. If inflation is high, then the cost of raw material, cost of labor, all increases. So if it is unexpectedly high inflation, all firms will be adversely affected. Other example is like political risk or natural disasters. For example, the 311 earthquakes in Japan or COVID-19 in the world that affect all the firms in the market. So that is systematic risk or market risk. Okay, like some of you may argue, like COVID-19, although like most of the firms suffer, but some companies like those who develop the vaccine or those who produce face masks may benefit from the pandemic. Agree, but that is like very small portion. So overall speaking, the whole economy suffered. Now, then you see here is example that I will illustrate how diversification can reduce risk. Maybe I draw it out. Okay, then you can follow easier. 咁我畫一次出嚟咧，張呢度大家容易啲去 follow 啊。Now here we assume there are two companies. I mean two stocks. The first one is a hot pot company. You know hot pot, and the stock price is now at 100. And other company is a selling ice cream. And the stock price is also at 100. Now, these firms are facing a risk factor. That is the temperature or the climate may be unexpectedly hot or unexpectedly cold. We don't know next year or next season the temperature will be unexpectedly hot or cold, but we know that there will be 50% chance unexpectedly hot and percent chance that it is unexpectedly cold. So, students, can you tell me if the temperature is unexpectedly hot, hot pot company will gain or lose? Hot pot company will gain or lose if the temperature is unexpectedly hot. 如果天氣咧超乎尋常地熱啦，打邊爐咧會點啊 ？Okay, yes, hot pot company will lose because of less sales. So the stock price will go down. Let's say from 100 to 98. So that is lost 2%. On the contrary, the ice cream company will get extra sales. Let's say the stock price will grow 5%. When the temperature is unexpectedly hot, it is just opposite. Hot pot company get additional business, but the ice cream company will suffer. Now, imagine there's no diversification. No diversification. That means we either only invest in hot pot company or we either invest in the ice cream company. Then what is the expected return? What is the expected return? To calculate the expected return, we have to calculate the weighted average or probability weighted average return. So we have a 50% chance to get 98 and 50% chance to get 105. So it is likely that we can expect to have 101.5. I mean, half chance to get 98 half chance get 105, take the average, it is likely that we will get back 101.5. Convert it into percentage return, the expected rate of return is 1.5%. Can you follow? Okay, good. Now follow the same logic. If we only invest in ice cream, 1.5%. Now, as long as we cannot predict the change in climate, although we can expect for 1.5%, but is this return certain or uncertain? It is uncertain because maybe we can earn $5. We may also lost $2, right? So you are facing some volatility or uncertainty in the return of your investment, right? In Cantonese. 咁你會發現咧，如果你買一隻咧，雖然你嘅預期回報1.5%，即係5成機會輸2%，5成機會賺5%，除翻個機率咧，你預期可以賺1.5%。咁但係咪呢個無風無浪可以攞1.5咧？肯定唔係嘅，因為我哋唔知道天氣嘅變化。咁所以咧，嚟緊即係究竟係驚啊定係起啊？我哋係唔知。我哋要面對住咧嗰個投資嘅戶口嘅上落，可能係上，可能係落，唔知道。嗱 ，but what if with diversification? How? Let's invest $50 in hot pot and invest $50 in ice cream. Now we diversify, right? Then in this case, if we invest $50 in hot pot, if the temperature is unexpectedly hot, $50 will fall 2% and will become 49, right? And I mean hot and cold. And if it is hot, ice cream will gain 5%, and that will become 52.5. Agree, right? So similarly, on the right-hand side, now remember, when we diversify, we invest in both. Agree, right? So, if the temperature is hot, what is my portfolio value? How much is my portfolio value? Okay, we invest in both. If the temperature is hot, how much do I have? Can any one of you tell me? Yes, if I invest in both, I can get 101.5. But what about if the temperature is cold? How much I can get? The same. So that means the rate of return is 1.5%, right? But can you tell me, do I have to face any uncertainty of temperature change? Do I have to face the risk of temperature change? Do I have to worry if the temperature becomes hot or cold? Okay, the answer is no. So in other words, diversification successfully eliminates the risk factor of temperature change. If I don't diversify, I need to face ups and downs. Get it? Any question here? 同學們有冇問題咧？咁你會見到，如果我哋分散咗咧，咁無論天氣點樣變化咧，我都係好穩定咁樣有1.5% 回報。但唔分散咧，雖然你能夠預期有1.5，但係呢個1.5咧，可以係好高，可以係5啦，可以係好低-2。咁如果兩個都係1.5，即係如果拉勻我哋個預期都一樣嘅，咁我哋通常我哋假設啦，人就會中意無憂無慮嘅，人咧就中意咧冇唔肯定嘅地方嘅。咁如果你睇下邊，我哋就冇唔肯定嘅地方啦。睇上邊，你就要望天打卦咯喎，究竟賺定蝕得唔得啊？So any question? No question. Good. We will come back here to further elaborate a bit after a few minutes. So let's go back to slide first. Okay, to further elaborate a bit, with my previous example, so if the temperature is hot or cold, then if we invest in a hot pot, okay, hot pot, it would be something like this. If I invest in hot pot, when the temperature is hot, lose money, cold, gain money, hot, lose money, cold, gain money. But if we invest in ice cream, it's like this. They're moving in this opposite direction. If I diversify, no matter the temperature is hot or cold, I can guarantee to get 1.5% return. Okay, so now you get the idea how diversification can reduce risk. Okay, but I want to go a step further. If diversify, I can get 1.5%. If and the risk is 0, low risk. Doesn't it make sense, students? Can you try to answer my question? So in this case, low risk, positive return. Does it make sense? Like our general impression is that high risk, high return, low risk, low return. But is it possible that 0 risk but positive return? Make sense? Logical? No, it doesn't make sense. Then what happened? Or what will happen? Or what do you think? 有冇問題咧？冇風險有回報喎，係咪同我哋即係常識有啲落差？咁點樣拆啊？我哋呢度即係點樣拆咧？點令呢度講得通咧？嗱，可以咁講，係啊，真係可以冇風險有回報㗎咁樣。咁係一種拆法。另一種拆法就係係喎，咁係有問題喎。咁我哋要有啲嘢要喐喎。Now, okay, students, no risk positive return is impossible. Okay, now, let's ignore the time value of money. Okay, that is the risk-free rate. That is the return to time. Now, but here, if no risk, there's no return. If no risk, positive return, it doesn't make sense. Then what will happen? Now we call that the stock price of hot pot is 100, right? And the stock price for a ice cream is also 100. Now, buying them together, you can get 1.5% guarantee without uncertainty. Then students, can you tell me what will happen? Students, can you tell me if like investing in both stocks, you can guarantee get back 1.5%, then what will you do? Okay, let's assume the deposit interest rate is 0. Let's assume. Then what will happen? Like buying both, you can get 1.5% without uncertainty. Then what will happen in the market, students? 如果你知道咧，原來我咁樣買咗分散風險就執硬呢個 1.5% 啦，擺銀行存有0蚊，咁你會點樣做啊？ Students, the answer is to buy both. Am I correct? this what we call witness profit so attractive, then do you think there would many people want to buy so that they can get the return above the deposit interest rate? The answer is yes. Many people will want to buy. Then what will happen? Then the stock price will be bid up. Do you agree? If the price bid up, but the $98, $102 remain unchanged, then the return will fall. $1.5 to 1.4. But 1.4 is still very attractive, right? Then what will happen? That is, people will keep buying it until the price arrives 101.5. Then the return will drop to 0. Now we get the equilibrium. Low risk, low return. Now makes sense. Good. Then what about those people who don't diversify? Those who don't diversify, they have to pay 101.5 to buy the stock, but they still have to face 50% that get 98 and 50% that get 105. Actually, the rate of return or the expected return is 0. But the risk is not 0. Therefore, it is stupid not to diversify. And actually, no return, no positive expected return at all. Can you follow? 咁大家其實會爭住去買嗰隻股票啦，就會將個股價推高啦，推到去咧101.5咧就會收手啦。咁就真係咧 zero risk zero return 啦。咁有啲同學就會問咧，咁我如果係咁，我繼續唔分散會點啊？嗱，唔分散咧，個天氣都可能會熱同會凍嘅，股價咧都會升同跌嘅，即係個 risk 仲存在嘅。但因為你冇分散咧，你就冇辦法避開呢一啲咁樣嘅unsystematic risk 啦。咁你就搏一鋪啦，即係如果天氣熱或者天氣凍，你就一係就98，一係105。咁但係嗰個波幅咧個變化咧，即係平均嚟講咧，都係101個半啊。咁即係其實你根本係玩自己嘅，你嘅預期回報係0，但係你仍然面對緊風險。咁呢個就係個市場殘酷嘅地方，就逼使你咧最少都應該去分散風險。如果唔係，你只不過喺一堆firm specific risk 裏面團轉，而冇任何嘅回報帶到俾你嘅，得唔得？喂，大家真係要諗諗咧，去消化一下。即係你上堂想學嘢噶嘛？咁如果學完嘅嘢咧，現實世界咧你唔會做唔會諗咧，咁就唔係好理想啦。好，繼續。Now you understand. But from that previous example, we see some kind of risks are diversifiable, but not all. Say the y-axis is the standard deviation of portfolio. That means the risk of the portfolio. The x-axis is showing the number of stock. But if you hold one stock, you need to bear market risk and firm-specific risks. But if you add more stock, you will see that the unsystematic risk or firm-specific risk would start to decrease, because like they will cancel out the risk factor of each other, like ice cream and hot pot. Like you buy more and more, the firm-specific risk will become lower and lower. Eventually, if you hold significant, if you hold sufficient number of stocks, for example, 30 stocks, then the firm-specific risk would almost be diversified away, they will be zero. However, the market risk is something that you cannot eliminate, you cannot escape from, because just like you cannot escape from the inflation risk, you cannot escape from the economic risk of COVID-19. So that is something cannot be diversified away from the process of diversification. And as I mentioned, taking up firm-specific risk cannot generate expected return to you, but only market return can generate return to you. OK， 得唔得？咁我哋實際上嘅回報咧係嚟自 market risk 嘅，唔係嚟自 firm-specific risk 嘅。嗱，我機咧得返10% 電，好驚。盡快10分鐘之內講完啦。Okay, now introduce the concept of modern portfolio theory. Okay, let's continue. Now, according to theory, we can build different kind of portfolio, and some are better. Okay, some are worse. There is a portfolio called efficient portfolio. So what is efficient portfolio? Efficient portfolio are portfolio that have maximum expected return for each given level of risk. Okay, let's say here, given like 30% standard deviation, we can build portfolio A, B, and C. So which one is the best? C is the best, because given the same level of risk, C has the highest return or highest expected return. So C is the efficient portfolio. But what about the risk at 40%? When risk at 40%, we can also build different portfolio, D, E, F. So which one is most efficient? F. So in other words, at 30% SD, C is efficient. At 40% SD, F is efficient. Right? Then what about optimal portfolio? Now, optimal portfolio, let's refer to the portfolio that that can produce the highest expected return for the amount of risk taken by investor. Okay, let's look at here. But there are different kinds of investors in the market. 呢個世界咧有唔同嘅投資者嘅。Some are highly risk averse. That means they don't like risk. They hate risk a lot and a lot. They want to avoid risk. 呢班人咧就係怕死，見到風險咧就熬㗎啦。Another kind is lowly risk averse. That means they don't like risk, but not worry risk as those highly risk averse. They don't like risk, but if you can give them little bit high return, then they can justify. Okay, then can justify them to take higher risk. 呢班人咧 lowly risk averse 咧，佢係咪唔怕風險咧？唔係，佢都 但係咧佢對同呢班上面嘅人比咧，佢冇咁怕，同埋咧你只要願意俾少少回報佢咧，佢就會願意咧去 take up 好多風險噶啦。So these people are willing to take up higher risk if the portfolio can give them slightly higher return. And for these highly risk-averse investors, they are not willing to, or put it this way, they are only willing to take up slightly more risk if the portfolio can generate a huge additional return to them. So different people have different choice. For lowly risk averse people, that means brave investors, they are willing to take high risk in order to get high return. But for highly risk averse investors, they are not willing to take high risk in order to get high return. So they prefer I. All right. So that's why some people invest in low risk portfolio and some people invest in high risk portfolio. And these are what we call optimal portfolio. Now remember, there are many efficient portfolio. I, C, F are all efficient portfolio with their corresponding risk level. But for one investor, there is only one optimal portfolio. Okay, for highly risk-averse investors, I is the optimal portfolio. For mild risk-averse investor, C is the optimal portfolio, and so on. I repeat in Cantonese. 咁咧 ，efficient portfolio 咧喺每一個風險底下咧都有一個嘅，30% SD 就係 C，40% 咧就係 F， 如此類推。咁啊好多 efficient portfolio。咁但係係咪個個我哋都要投資咧？就唔係啊嘛。你怕死，咪揀 I 咯。咁 I 就係怕死嘅人嘅optimal portfolio。你唔怕死大膽嘅，你咪揀 F 咯。咁 F 咧就係唔怕死而大膽嘅人嘅 optimal portfolio 啦，得唔得 ？Move on. Now, introduce the concept of efficient frontier. Efficient frontier. It's very simple. Efficient frontier is a line that joins the efficient portfolio together, like this. Efficient frontier is this line. Efficient frontier is the line that joins the efficient portfolio together, and we get efficient frontier. Efficient frontier 就係將啲 efficient portfolio 咧串起上嚟嘅一條線。咁所以你而家見到呢條線咧就係 efficient frontier 啦。All right. So we go back to the concept of diversification. What make a good diversification? What make a bad diversification? Now, a good diversification, that is in your portfolio. You should have not so correlated assets. Not so correlated. Okay, what means correlation? Did you learn correlation before in statistics course? 有冇學過 correlation 啊？相關性、相關係數。嗱 ，for example, correlation 咧fall between -1 and +1. When it is -1, we call that perfectly negative correlated. And +1, we call it perfectly positive correlated. Okay, so this should be +1. Okay, so what means perfectly positive correlated? That means where two assets, their return always move in the same direction. For example, stock A goes up, stock B goes up. Stock A goes down, stock B goes down. Always move in the same direction. We say that they are perfectly positive correlated. But if two stocks always go into opposite direction, we say that they are perfectly negative correlated. For example, stock A goes up, stock B goes down, and then stock A goes down, stock B goes up. They always move in opposite direction. We say that they are perfectly negative correlated. Okay, for example, what stock are positively correlated? For example, like Coca-Cola and Pepsi-Cola, they have a similar factor affecting their price. So they are positively correlated, up together, down together in most of the time. Then what about negatively correlated? Negatively correlated, it is hard to find. So a related example is like stock and bond. Okay, stock and bond, like when stock price goes up, then people, they sell bond to buy stock. So stock price goes up, bond price goes down. Okay, the correlation is not so strong. Then when we form a portfolio, we want to form portfolio with negative correlation. Okay, or less than 1 is okay. But 1 is not okay. Let's say why. 我哋想分散咧，就唔想揀一啲 perfectly positive correlated 嘅，咁樣係冇用嘅。點解咧？嗱 ，here you see, this is stock A, and the dotted line is stock B. If you form a portfolio with stock A and B, then we get this line, okay? Stock A up, stock B up, stock A down, stock B down. So you get the portfolio move just like stock A and stock B. So in this case, student, can you tell me, do you think the risk is reduced by diversification? Do you think the fluctuation is reduced by diversification? 你覺得個風險有冇分散到啊？嗰個波動率咧有冇比咧單買一隻少啊 ？Lower, yeah. So stock A and stock B are positively correlated, and the benefit is very small. But in this case, now stock A, this one, stock C, the dotted line, they move in opposite direction. That means they are negatively correlated. A up, C down. A down, C up. A up, C down. In this case, you can see they move in opposite direction. And if you combine A and C together, you get this portfolio. Now, look at the portfolio. Do you think the volatility measured by standard deviation, do you think the volatility is less than A or less than C? Yes or no? Do you think the portfolio has lower risk than individual stocks? Yes or no? 你覺唔覺得呢個 portfolio 咧，佢嘅風險咧比單隻股係細啲啊？嗱，單隻股係咁樣發嘅。但係個 portfolio 係咁樣嘅，係咪柔順啲啊？驚唔驚啊 ？Okay, so combining stock with negative correlation or correlation less than 1, then we can benefit from diversification. Okay, last concept in 2 minutes. The last concept is about how to calculate portfolio return. It is very simple. Now, if we hold more than one stock, then what is the return? It is just the weighted average return of individual stock by this formula. For example, we hold 3 stocks. Stock A, 20% out of 100%. Stock B, 30% out of 100%. Stock C, 50% out of 100%. W refer to the portfolio weight. That means if I invest $100, $20 in A, $30 in B, and $50 in C. No problem, right? RI refer to the return of the stock. Stock A generates 5% annually. Stock B generates 8% return annually. And stock C generates 10% annually. So if I hold a portfolio of 20% A, 30% B, and 50% C, what is my portfolio return? Simple. 20% times 5 plus 30% times 8 plus 50% times 10. Then we can get the answer. If I hold this portfolio, the return is 8.4%. Is that clear? And next slide, you can see an example. Okay, you just use the same method. You just use the same method as I mentioned here. Okay, so you can try to practice at home. Good. Any question? If no question, that's all for today's lecture. Thank you very much. Happy Friday. Happy weekend. 有問題就問，冇問題就再見。